again, Solis Wealth family. Greg Solis here with the update. First on the family front, we're doing well. Everybody is settled in. Jack is in San Diego. He actually got his own apartment and I didn't have to co-sign or anything. So that's good news. He paid his own rent. He did the first and last, so that's good. Nicole's doing great, loving her new job. She's in Hawaii, living in Waikiki, working hard. So she's a working girl and she's a happy camper. So she's doing great. Emily, of course, loving life at TCU in her sophomore year. They finished Rush. They got a great pledge class. She's back into her academics. So everything's going great for Emily. Monica and I are enjoying our lives as empty nesters. So life is good here with the Solis family. I hope it's good with you and your family as well. Market-wise, well, it was a pretty volatile week. Again, Luis and I talked about this a couple of weeks ago that expect volatility, and volatility there has been. We're selling off a little bit right now as I record this video, or the S&P 500's off right about 3% off of its all-time high. So not bad, it's hanging around its all-time high. NASDAQ's still off about 8% from its all-time high. So the tech stocks are taking a little harder hit. Some of the artificial intelligence companies that had some big run-ups, a lot of profit taking, a lot of things going on there. But what's going on right now really is there's a softening of the economy. There's just no question about it. As we've been talking about, the Fed, of course, raised rates to slow things down and try to get inflation under control. We did get inflation down. We see inflation under 3%, which is great to see, but now we're seeing the labor markets really beginning to weakening. As a matter of fact, we saw deceleration of labor growth by 5 months in a row. So we are definitely seeing some softening. Now the question is, what will the Fed do here in the next couple of weeks? Will they lower the rates 25 basis points or 50 basis points, 1/4% or 1/2%? We believe we might see a 0.5% in decrease in the Fed funds rate. So good news for the bond market. We're seeing interest rates come down. As a matter of fact, the 10-year Treasury is down about 1 full percentage point. It was at about 4 3/4. Now it's hovering right around 3 3/4. So that's good news for mortgage rates and borrowers and things like that. Good news for the bond market, because as interest rates come down, the value of bonds go up. That's good. Bad news for money markets. We're going to see those money market rates come down a little bit and CD rates come down a little bit. So it depends upon what side you're on. If you're a borrower, you're going to like the lower rates. If you're an investor, we kind of like having these higher yields, particularly on short-term money markets and things like that. But again, for us that have long-term bonds or intermediate-term bonds, those bond prices have gone up a little bit with interest rates coming down. So the bond market looks pretty good. Equity markets hanging in there, looking pretty good, but expect a lot of volatility, expect the Fed to be lowering rates, and hopefully we won't slip into a recession. We still think that we are coming into a soft landing, so we remain cautiously optimistic that we'll continue to see the markets move upwards over the next several months. So, but hang on tight, as I always say. Of course, if you need us, you know we're here for you. My very best to you and your families. Hope to see you at the Client Appreciation Party. That's coming up quickly in November. My very best to you. God bless. Take care.